We're talking the markets, the Fed, and of course, I need to get a question in there on gold. Joining me today is Mr. Wonderful, Kevin O'Leary. Welcome back, Kevin. Good to see you again.
Great to be here. Thank you.
Let's start with the news of the day here. Caterpillar missing earnings, NVIDIA cutting guidance for 2019, both really pointing to a slowdown in China here. As earnings season gears up, do you think this is going to be the theme we'll see?
Yeah, the haves and the have-nots, definitely. More volatility for sure, and a whole change to the tone of the market. Let's go to 60,000 feet and start there first as an equity investor. The reason you would want to stay long in, let's start with large cap US domestics, is two reasons. Number one is fixed income is not yet a competition if your mandate is to make 5 or 6%. Most institutional investors have a mandate to make 5 or 6% annually, one way or another. Very hard to achieve that without taking significant duration risk in fixed income or taking quality risk in junk debt. So equities still look very attractive because you're getting 2.5% div yield plus hopefully maybe 4 or 5% capital appreciation with an undertone of 7% earnings growth in 2019. That's the big picture. Here's the problem. There's now a difference between a quality stock and one that has too much leverage, doesn't have enough cash flow, doesn't make any money, and the market is now sifting through them. And when you get misses, and even big names like Caterpillar, you're going to pay 6 to 10%. Institutional investors don't like that. They're trying to weed out that volatility. They're seeking alpha and security. So my new theme for 2019-2020 is balance sheet. It doesn't matter what sector you're talking about. You want the best balance sheet in every sector. More than the last 3 years, for sure, because this year, owning the boring Pfizers and P&Gs and all that stuff with great balance sheets is where you can hide in the weeds and maybe make 5 or 6%.
So what's Kevin liking right now then?
Say that again?
What are you liking right now then?
So I have gone into the ETF market where the Goldman Sachs, iShares, certainly my own firm, O'Shares, we're developing indices that mine quality out of the S&P. And I'll give you an idea of these tickers. Certainly OUSA, the one I worked on, but Goldman has GSLC and QUAL is iShares. In a day like today, if you looked at those three indices, they're dramatically outperforming the S&P because they have used algorithms and rules to mine for alpha and mine for quality. Each defining quality a slightly different way, but the point is you're much safer, in my opinion, owning these types of indexes than you are the S&P overall, because there's a lot of garbage in the S&P right now in terms of low quality balance sheets.
Turning to the Fed now, Kevin, seemingly more dovish since their last rate hike in December. Where does it go from here? How do you see it playing out?
I don't think we're out of the woods on rate hikes. I think, at least Powell came back with a data-driven message and took the bite out of what he did late last year. And a new Fed head generally has a little bit of a learning curve in terms of how they find their voice. He was abrupt and brutal in the beginning and caused a lot of chaos, and he must have woke up one morning and saying, did I really cause the market to go down 2.5% in one trading day? And say, maybe I should tone that message, which he did, and I think I applaud him for doing that. The message is more data-driven, as it should be, but I think it's not impossible to get another 50 basis points in 2019 if we get an inkling of a trade deal with China. And that's the other big reason you need to stay long equities. If we woke up tomorrow morning and Trump cut a deal that protected us against IP, gave us access to markets, and stopped government subsidies on Chinese companies vis-a-vis competitors internally there, the market would go up 15% in a week. And that's what you're protecting against when you stay long equities. It's just which equities. So for me, it's finding quality, sitting in the weeds, making my 2.5% div yield with a good quality company, waiting for the administration to deliver in the next 2 years a trade deal with China. That's going to be the next leg up in the market.
And speaking about protecting wealth, gold getting a bid here, perhaps on the news from the Fed here, breaking through 1,300. But I think what's really important to pay attention to is we're seeing billionaires who never bought gold before, like Sam Zell, buying gold for the first time. We're seeing central banks that never bought gold before buying for the first time. Is this telling us anything?
Well, gold was dead money for the last 2 years because there was a theme that cryptocurrencies were going to replace gold as the long-term asset. That turned out to be bunk, and gold is back, as it has been for 2,000 years. To me, gold's always the same position. It's a 5% weighting in my portfolio, adjusted each quarter, up or down to 5%. It's been dead money. Now it's actually providing a lot of stability. I'm back up at a full 5% weighting. I use very blunt instruments. I buy the actual gold, physical gold, and I store it and pay for that. And I buy GLD to adjust my position. I do not own miners, because I've always had the same theme. I've said this for years. Why let idiot management get in the way between owning the commodity and getting out of the ground? For almost 20 years, they have underperformed in their costs of projects, in their merger deals. They're terrible at running the process of extracting it from the ground. Why have anything to do with them? Just buy the actual gold.
And look at all the mergers taking place in the space right now.
Yeah, there's an interesting story occurring here. Canada, which used to be the leader in financing mining, is getting decimated. London is now where people raise their money, and all the headquarters are leaving Canada, moving to other jurisdictions because of really punitive tax policy in Canada around corporate taxation and around CapEx expenditures. That's more of a political tone, but we probably can now measure the cost of a really bad administration, particularly finance. This finance minister is perhaps the worst I've ever seen in terms of understanding what it takes to keep the country competitive. He single-handedly has decimated the resource sector. I just wonder how long until we find competency in some of these policies.
It's funny, I had Rex Murphy on the show last week, and he was saying that he loves moose like the next Canadian person, but he also values growing the economy more. I don't know if how you see it.
No, I get it. I don't get involved in retail politics currently. I just look at policy. I have never seen such incompetence and weak management at the federal level in my life. The policy has decimated the country's competitiveness. In the last 36 months, direct investment in Canada is down 52%. It's no longer considered investable. Who do I blame for that? Justin Trudeau and his band of incompetent managers.
We're going to talk more.
And we should. It's important that the Canadian people take stock of what's happened to them, and I am a Canadian citizen. Our country's uninvestable.
And we're going to talk more on the Canadian political front with you, Kevin. Thank you so much.
Thank you.